At the big earnings today, India's second largest private sector lender HDFC Bank managed to meet street expectations in Q2. This despite a hike in provisions and contingencies in the quarter gone by. Ritu standing by with the highlights. Ritu, so HDFC Bank steady?
Operationally, a very good quarter for HDFC Bank. This is Q2 of FY18. In fact, both the top line and the bottom line numbers are more or less in line with what the street had estimated. So profits saw a growth of over 20% at 4,151 crore rupees. This is despite a sharp rise in provisions over the previous year and an increase in the tax expenses. Of course, it was supported by the fact that other income was higher. Net interest income was good, which rose by 22% over the previous year at 9,752, supported by in turn advances growth of over 22% on an overall basis, where domestic advances were up by 26.8%. Asset quality, well, it was largely stable with gross NPAs at 1.26 versus 1.24 in the previous quarter, and net NPAs at 0.43% versus 0.44 in the previous quarter. But there was one sticking point where the bank said that there was a particular account that it had extended a loan to in a consortium where it had a 2.3% part in the entire project finance loan, which was identified by the Reserve Bank of India in terms of some divergence noted, but HDFC Bank maintains that it is in dialogue with the regulator, and therefore as of Q2 it has not classified that account as a non-performing assets but has made adequate provisions to that extent. Of course, the impact of this is yet to be seen, whether it will fall in the next quarter or not at all. But other than that, even margins were pretty strong at 4.3% compared to 4.4 in the previous quarter, well within the guided range of 4 to 4.5% for HDFC Bank. Again, far ahead of the industry estimates and averages. So all in all, a good set of numbers. The only clarity remains as far as that one account is concerned, where RBI has expressed some concern.